Yo, 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 what is up, guys? Welcome back to another Thompson's 2 cents. Larry Thompson in the house. I'll be ripping through a couple charts today, but something I really wanted to cover today was putting on these, nerdy glasses. You see the books behind me. I know I like a lot of charts, but also I think the psychology of the market and understanding some of the traps that we can fall into. Especially with technical analysis, there's this thing I refer to as the simplicity trap. Right. Early in my career, I thought technical analysis was one thing, and now I'm learning, right, there's levels to the game that you can build upon. So that's really what I wanted to dive into this week is kind of the trap that most young traders, young investors fall into when it comes to technical analysis and when it comes to many aspects of life, not just technical analysis. So let's kind of get into it, covering the simplicity trap. And of course, there'll be some charts. And honestly, at the end, I'll be sharing kind of a robust framework that I use to kind of circumvent some of the simplicity traps that exist. So Albert Einstein said, everything should be made as simple as possible, but not simpler. And I think we see this quote a lot of times in society, and people forget about that end, but not simpler. And I think the problem with technical analysis is that it looks simple on the surface, right? That's the trap. Technical analysis looks simple on the surface, right? And so then we confuse that with the work itself being simple, right? And so what did Albert Einstein say? Simple as possible, but not simpler, right? So if you understand those two things, and then if you've read, right, some of those books behind me, the CMT curriculum, or some of these books over here that are philosophy books and religion books even, you understand human nature has a tendency to, right, to swing one side of the pendulum, right? Very political, like politics is a great example of that, very one side of the pendulum. So this quote, I think, highlights that, right? Not simpler, because we can then swing too far that side of the pendulum. And so I'm seeing that a lot right now in the technical analysis community by some of the people who might be newer to it or haven't studied the curriculum, haven't put the work in to really understand how to circumvent some of these things. So I wrote about this week in one of my blogs. I said, yes, I see the potential divergences, bearish divergences, right? That's an observation people are making, right? Simple. Observations are simple, but it's one piece of potential bearish data stacked against a mountain of bullish evidence. I'll worry more when bearish data becomes the rule, not the exception. Okay, so people are simple or observations, right? So it's easy, right? You think of technical analysis, you think of charts, right? But there's a lot more to it than that. And that's what I'm highlighting here is that you can take this weight of the evidence approach to kind of approach it. And we'll get into that in a sec. Just wanted to show here, this is a chart, right? I talked about this last week on the show with JC Peretz on the morning show. Shout out JC. Talked about semiconductors and people talking about this bearish divergence, right? Prices made higher highs, momentum made lower highs. And it's a good observation, but to me, it's not analysis. You're observing something and you're not providing context of the underlying trend. You're not providing the thought process that goes into understanding the market regime. You're simply pointing out an observation. You're making it too simple, okay? Simple as possible, but not simpler. So what did I note in that note? I noted that we have to understand the context of the underlying trend. We understand where price is coming from and where it's going, right? We had a pullback from this divergence to support above a 200-day. We know the trend is our friend. Don't fight trend. That is the basis of a lot of technical analysis, is understanding that the robustness and strength of trend. And then what happened, right? We had this failed top, bull market characteristic, right? We had price consolidate sideways. And then this week we made all-time highs. You might be like, oh, what about the chart pattern? It looked like it was a top. I've seen tops fail before. I've seen they normally work. Well, not in the context of bull markets, right? And bearish patterns show up a lot in bull markets. Why? Because you're not going to have a bearish divergence unless price is making higher highs. What do uptrends do? Make higher highs. So don't confuse this observation for analysis, right? See that all the time. An observation is not analysis. A stock making an all-time high is an observation. Understanding the context of that all-time high and whether or not it can persistently do that is the analysis. So, right, what's the solution to this problem? The solution is turning those simple observations into robust frameworks that provide context to when and where those observations occur. Okay? Like we just did here with the semiconductor chart. Okay? There's other frameworks we'll get into in a minute, but what do we do? Right? We turn that simple observation and then we built a framework of understanding the underlying trend of the market, right? And we provided context to that bearish divergence that was taking place in a bull market, in leadership, above support. And then, right, the next step is when and where those observations occur, right? Is occurring at those support levels. And so analysis would tell you, it's a consolidation. Observation might tell you, hey, you need to panic. You need to sell here, right? It's going to break down. Until we had that follow through, it was just an observation that didn't have that follow through. So that is the solution. And we'll go over a framework today that I've built kind of utilizing a lot of the skill set that technical analysis involves, because it's not just charts, right? Chart is the data visualization of a lot of the data that we use, right? Fundamental analysis uses charts, right? When you look at a PE ratio chart, when you look at a earnings estimate chart, when you look at our earnings growth chart, right? So it's not just the charts. Charts are the language in which we communicate it, but it's not just charts. So let's get into it here. Another example of a framework. I talk about this one every single week. It's the first chart I show, so kind of teased y'all a little bit not showing it first. But this is a framework chart to a degree, right? It's using some robust methods, right? We have momentum in the top, we have breadth in the bottom panel, and we have multiple cycles here, and we're providing context for the current price action, right? When and where is this occurring? When and where is the breakout occurring? When and where is the new high occurring? When and where is the bearish divergence occurring? When and where is the MACD crossover occurring? When and where is the sentiment reading that's poor occurring? When and where is the VIX spike occurring, right? You do all of that, and you understand that within the context of an underlying uptrend, you discount those observations, right? They don't provide as much weight of the evidence to the framework. And so here, right, we had the V-shaped recovery in 2020. We had a longer recovery in 2022. And we had our most recent tariff tantrum recovery. And on this bottom panel, I'm highlighting the price kind of had some chop, right? Some post-breakout chop. And I said it might, right? You could anchor to that. You could use that as an example using analysis to say we might chop a little bit here. And guess what we're not doing? We're not chopping. We're not chopping sideways here. We're actually breaking out and continuing to the upside. And that, right, is information that this trend is stronger than imposed. We're seeing breadth still expand. We're seeing things underneath the surface. Right underneath the surface is those robust frameworks that is confirming that the context of this continuing higher is likely. And if it doesn't, we set trailing stop losses and those types of things. So that was the point I wanted to kind of make today about this video, is like use all of your tools you can. So let's kind of get into this bottoming framework that I built, right? So I don't just want to give you guys something and then not give you where or how you can understand or get this data. So look at this. This is a bottoming framework, right? And so what we have here is we have the indicators, right? The observations. Okay, we can populate the current reading, and then we have a signal, right? Understanding the signal of those, and then you apply a score, right? To then give it significance, right? So for this one, for example, we have here price trend data, we have breadth, we have sentiment, we have volatility, and we have momentum. Okay, I haven't applied every single indicator in the world to this one, but it just kind of shows you that you can take those simple observations and then build a framework. So, right, less than 15% of stocks above their 50-day moving average. That's signs of capitulation in the stock market. Less than 10% of new NYSE stocks making new highs. Signs of capitulation. Capitulation meaning there's not any sellers left, right? Capitulation meaning that the fear news could get worse. but the market is currently pricing in where everyone who's going to sell has most likely sold. Capitulation type. VIX, similar, right? VIX above 35, the panic fear gauge. VIX term structure inversion. Understanding that people are paying a premium for short-term insurance instead of long-term, right? Which typically, the more time you give something, the more likelihood that that thing can occur. Think about options, right? If options term structure, right, the longer dated are more expensive than the shorter. So when the VIX term structure inverts, right, they're paying a premium for short-term insurance and not for long-term. That's typically a sign that the worst is priced in the market. Right? AAII's put call ratio, right? Also sentiment gauges, understanding capitulatory environment, right? Positioning is probably already to the extreme because if you're really bearish, you've probably already gotten out of the market, or why would you be bearish, right? And then some breath thrusts, a bullish divergence, right, would occur in a downtrend, just like the bearish ones occur in the uptrend, applying that context. And then indexes drawdown being greater than 20%, right around 20%. Okay. You can then apply a score to that, right? This would be just a framework, a bottoming framework. You apply a score, right? Say above 5. Okay. Above 5. Okay. I want to start looking for opportunities to enter the market. So then what do? This is context. This is the framework. This is the analysis. We then take that and execute it via price. That's the beauty of technical analysis. It's not solely the price chart. It's that we then have risk reward and ability to execute it. So this is back from April 7th. If you guys are familiar, it's right around the time when the market bottomed. And I'm not sharing this to pat myself on the back. I'm just sharing this to show you that price alone may not have told you to get long the market. But using the context of when and where this was occurring, right? Keeping it simple, but no simpler. You can see, holding my nose and swinging the bet against 480. Capitulation signs are there. This early, but the risk reward is great. So my signals from my framework were firing, but even more importantly, the risk reward was great against 480, where I knew, okay, if we continue to the downside, I could get out here, but 480 was a good, clean risk reward level. It worked out. It's not always going to work out that way, right? Now we're back at all-time highs above 600, right? So 480 to 600, great move to capture that. And the trend has stayed strong since. And so what I wrote over here was just an epiphany that I had kind of building out this framework, is that it's not as simple as people make it, but it's not hard either, right? It's not necessarily make it really, really hard. It's just that it requires a little bit more work than people show you on the surface. And it takes time to build that. So I'm youngish. I think the moment that will really define how I view the markets, I said here, right? This represents everything I didn't know during the 2020 V bottom, which I showed a chart earlier, right? And what I learned since 5 years of growth to be prepared versus being panicked when opportunity comes. So over those past 5 years since the 2020 bottom, right? I read those books up there. I got my CMT license, which is behind me. I'm also a CPA, but I love that one because it just represents something I'm passionate about. All these books are CMT related technical analysis books that help you build frameworks. And it helped me make money. It helped me look like a genius in the moment because we were able to build a framework that helped me see the panic in the market and buy it instead of panicking like I did in 2020. And that's actually the genesis of how I kind of got really involved with this market, as I took ownership for it, and technicals is a great way to do that. So guys, just in terms of that, right, I kind of showed you a couple things today. Go back, rewatch the video. The point of this is keep it simple, but no simpler. If you're looking for additional resources around this, I wrote a blog about this on my Beehive. It's at Hostile Charts, but it talks about like always being a student. So here are some of the resources I would recommend. The first book I would read if you're new to technical analysis is probably one of these OG books, Technical Analysis of Financial Markets, Technical Analysis of Stock Trends. Those books, like I said, there's links in there. The book I read the most when it comes to like helping understand frameworks and being research driven when it comes to the analysis is this book by Ned Davis called Being Right or Making Money. You can see a lot of notes have come from this book and kind of understanding how you can take price action, you can stack probabilities in your favor, and you can understand the context for when things are occurring and have a systematic process, right? You don't have to necessarily have systematic triggers, but a systematic process to help you stay on the right side of the curve. The other one I would recommend, similar, right? Another guy that actually works at Ned Davis is Timothy Hayes, The Research-Driven Investor. Another great read that really helps you kind of understand market regimes, understanding when it's a bull market, a bear market, when you should be pressing the gas, when you shouldn't. And that's kind of the message of last week's. The market message was actually taking some of my framework, right? My risk metrics, my breadth, my momentum, and building those out to understand we should still be thinking opportunistically in this market. Because the weight of evidence, right, taking those simple observations and giving them a weight, right, is saying to still be opportunistic. So that's what I had today, guys. I'll give you guys some time to digest this. Let me know in the comments if you guys have any questions, right? Any questions or any concerns relating to this information. I'm here, right? If you need any resources, I'm here. I will just tell you, I know there wasn't as many charts today as there normally is, but next week we'll be running my favorite show that I do, which is all gas, no breaks, 20 stock setups in 20 minutes. So next week it'll be a minute a chart. So we'll have 20 charts, 1 minute each, ripping through them. My last one it's the most successful show that I do, and I really do recommend that you tune in. I would also just say, if you're looking for more of my work, right, I write a blog every Saturday. And then Sunday stock list, if you could only read one thing of mine, read the Sunday stock list. It's quick, it's simple, it's every chart that I'm eyeing that upcoming week. It's normally 5 to 10 charts that I'm eyeing this upcoming week. I might include a little extra this week because, in the show, I kind of went on my philosophical rant. But overall, guys, I love the support. Please leave a like or a comment. That's the best way you guys can support me and just show that you guys enjoy this type of content. That's why I'm doing all gas, no breaks again, because it got a lot of views and a lot of likes. So if you like this type of content, kind of diving a little bit more into the philosophical side, a little more the educational side of technical analysis, let me know. But with that, much love. Peace.